A revocable trust is the corner of most modern estate plans. Revocable trusts, as their name implies, can be very easily altered to take into account changes in the law and changes in your personal situation. They can have some tax planning aspects to them as well, establishing such things as credit shelter trusts after you pass. But the great thing about the revocable trust is its flexibility. Unlike other types of trusts, generally speaking, a person that sets up a revocable trust can be his or her own trustee, as well as the current beneficiary of the trust. So, uh, administration of the trust while the individual is alive is extremely simple. The trust can use that individual's social security number as its taxpayer identification number and does not need to file a separate tax return. So it doesn't add a lot of complexity when it comes to the compliance side. After a person passes, a revocable trust becomes irrevocable and is governed according to its terms. Trusts are a bit of a hybrid. Under state law, they're considered a contract, an agreement essentially between the grantor, the trustee, and the trust's beneficiaries. But for federal tax purposes, after a person passes away, a trust is considered a separate taxable entity and will need to get its own taxpayer identification number, either for the period of time that it takes to administer the trust and distribute its assets, or in some cases, the trust will continue on, generally speaking, for tax protection purposes or potentially to hold items in trust for young children until they reach the age of majority, or perhaps what we like to call the age of maturity. Many clients don't want to be giving their children millions of dollars at age 18, and they tend to space out the distribution of their trusts to maybe a third at 25, a third at 30, final third at 35, with discretion in a third party trustee to distribute assets ahead of that schedule for things like health, education, maybe purchasing a new house. So trusts are a highly flexible instrument that can be a cornerstone of everyone's estate plan. It's a great way to avoid probate. It's a great way to protect from excessive taxation if you have a larger estate or you live in a state like Massachusetts with a low estate tax threshold. It's also a great way to avoid ancillary probate in other jurisdictions if you have real estate or businesses in more than one state. Thanks, and look forward to working with you.